Coca-Cola, the global behemoth synonymous with America, is reportedly considering leaving the United States. The reason? Tariffs on aluminum, making the cost of producing their iconic cans skyrocket. This isn't just a dry business decision, it's like baseball moving the World Series to Luxembourg. Coca-Cola's CEO James Quincy describes the situation as untenable due to aggressive trade tariffs. These tariffs are fundamental threats to Coca-Cola's ability to operate efficiently and profitably within the U.S. The very consideration of such a monumental move underscores the severity of the impact these trade policies are having on businesses. It's a flashing red warning light for the broader American economy. How did we get here? A significant portion of the blame lies with the trade policies enacted under President Donald Trump's administration. These bold, confrontational actions reshaped global trade dynamics, including a hefty 25% import tax on steel and aluminum. Major trading partners like Canada and China responded with their own tariffs, creating a volatile trade environment. Aluminum is fundamental to Coca-Cola's packaging, and the U.S. imports nearly half of its aluminum supply. The 25% tariff dramatically increased the cost of this essential raw material. Coca-Cola faces a steep rise in input costs, impacting its bottom line and product affordability. The broader disruption caused by these measures affects the entire global market, even domestically sourced aluminum. For a company producing billions of cans annually, even a small cost increase translates into millions in additional expenses. This immense financial pressure drives their drastic consideration of relocating. Tariffs on aluminum are just the tip of the iceberg for Coca-Cola's escalating costs. Trade disputes have led to price spikes for other crucial imported ingredients. Coca-Cola's global operations rely on intricate supply chains, now disrupted by tariffs. Faced with skyrocketing aluminum costs, Coca-Cola is considering increasing its reliance on plastic bottles. This move is controversial due to environmental concerns and the company's sustainability targets. Coca-Cola had aimed for 50% recycled materials by 2030, now scaled down to 35 to 40% by 2035. Economic pressures from tariffs clash with sustainability goals, highlighting the difficult choices companies face. If Coca-Cola leaves Atlanta, where might it go? Europe is a strong contender. Europe offers a stable political environment, efficient logistics, and favorable trade agreements. Countries like Germany, the Netherlands, and Switzerland are potential new bases. The motivation is to find an environment where Coca-Cola can manage its supply chain without crippling costs. Moving headquarters is costly, but the long-term benefits might outweigh the short-term complexities. Europe offers a massive single market and established trade deals, simplifying operations. These countries have skilled workforces, excellent transportation, and a pro-business environment. The political climate in Europe is generally more stable than recent U.S. trade policies. Coca-Cola's decision would involve evaluating factors like tax rates, labor laws, and regulatory environments. Coca-Cola's potential departure from Atlanta would be a profound blow to the U.S. It stands as a globally recognized emblem of American entrepreneurial spirit. Its exit could be seen as a vote of no confidence in the American economic environment. The tangible economic impact on the American workforce and economy would be substantial. Labor unions fear a domino effect, leading to more corporate relocations and job losses. Moving Coca-Cola is an operational challenge of Mount Everest proportions. Dismantling over 50 U.S. facilities involves transferring specialized equipment and real estate. Relocating corporate offices includes migrating critical IT infrastructure and renegotiating contracts. The human element involves retraining staff, managing redundancies, and transferring sensitive data. In Europe, Coca-Cola would face new regulatory challenges, including environmental standards and labor laws. The move would require a fundamental recalibration of brand identity and global narrative. Coca-Cola's departure would not go unnoticed by competitors like PepsiCo. PepsiCo might position itself as the more authentically American choice. Smaller regional brands could gain market share during Coca-Cola's transition. American consumers might face higher prices and fewer choices. On a geopolitical scale, Coca-Cola's move could embolden countries advocating for freer trade. The new host country might gain leverage in future trade negotiations with the U.S. The entire saga highlights the interconnectedness of global trade policies, corporate decisions, and environmental sustainability.